All right, let's jump right back into the explainer. I'm really excited about this one because we are tackling one of the absolute most practical, real-world concepts in financial accounting. In our previous lesson, we mapped out the four-stage OCI journey, the life cycle that literally every other comprehensive income item goes through. Well, today, we're putting that exact framework into action by zeroing in on Category 1, Cash Flow Hedge OCI. Now, think of a cash flow hedge as a corporate shield. Companies deal with incredibly unpredictable cash flows all the time, right? Interest rates randomly spike, foreign currencies totally plummet, commodity prices go through the roof. To protect themselves, they use hedges. And as we're going to see today, the accounting behind these shields is absolutely fascinating.
So quick look at our roadmap for today. We'll start by defining cash flow hedges, then we'll walk through the 4 hedge stages, look at some common real-world scenarios, get our hands dirty executing the actual journal entries, and wrap up with the critical reclassification rule. Okay, Section 1. Let's dive right in and define the hero of our story here.
So what exactly is a cash flow hedge? Well, the formal definition is that it's a derivative instrument designated to protect against variability in future cash flows caused by a specific identified risk. But let's actually break that down. A company knows for sure that it has a cash payment or receipt coming down the pipeline. The problem? The exact amount is totally uncertain, maybe because of wild floating interest rates or, foreign exchange volatility. So they buy a derivative to lock in that cash flow. Now here's where OCI enters the chat. When a derivative qualifies and is formally documented as a cash flow hedge, the effective portion of its fair value changes goes straight to OCI. Why? Because the actual economic benefit or cost of that hedge won't be realized until the future cash flows finally occur. So OCI acts as this perfectly designed waiting room, keeping all those unrealized gains and losses safely out of current earnings until the exact right time.
But to use that waiting room, you've got to play by the rules. And this elegantly simple quote highlights literally the biggest vulnerability in the entire process. Hedge designation documentation must exist before the hedge begins. Let me say that again because it's absolutely paramount. You cannot just create it retroactively. If a company buys a derivative and says, we'll just write up the documentation next month, well, their shield completely fails. Without that proper day one documentation, all the fair value changes of that derivative bypass OCI entirely and hit earnings directly. That creates massive unwanted volatility in the income statement. It's exactly the kind of unforced error that keeps auditors awake at night. You absolutely must have your paperwork ready on day one. Understanding that day one rule perfectly sets us up for Section 2. Let's map out the life cycle of this cash flow hedge.
Let's walk through the exact timeline this follows. It all kicks off on day one, inception. This is when the company officially designates the derivative as a hedge, confirms it's highly effective, and files that super crucial documentation we just talked about. Interestingly enough, there's actually no journal entry here. The hedge simply turns on. Next, we hit the reporting date. This is when the derivative's fair value shifts. The effective portion of this change is measured and parked safely in our OCI waiting room. Then comes the transaction date, also known as the hedged event. This is the big moment when the underlying transaction, like say a variable interest payment, actually hits earnings. At this exact second, we trigger reclassification, yanking that amount right out of OCI and dropping it into the income statement. And finally, maturity, where the hedge ends simply because the derivative expires, is terminated, or management revokes the designation.
All right, Section 3. Those are the abstract stages. But let's ground this in reality. How do companies actually use these things out in the wild?
You're generally going to see 3 really common scenarios. First, imagine a company holding floating rate debt. Their primary risk is a variable interest rate. Their weapon of choice? An interest rate swap, where they pay fixed and receive floating. When that reclassifies, it hits the interest expense line. Second scenario, think of a European company forecasting US dollar revenues. Their huge risk is the foreign exchange rate. So they use an FX forward contract to sell those dollars and buy euros at a completely locked rate. That eventually impacts the revenue line. And third, picture a manufacturer stressing over the cost of raw materials. They'll use a commodity futures contract to lock in a specific purchase price, which ultimately gets reclassified into cost of goods sold. For the rest of our time today, we're really going to anchor our focus on that first scenario, the interest rate swap.
Let's move into Section 4. Time to step out of the theory and get into the actual debits and credits of our interest rate swap.
To keep things nice and clean, we're going to outline the strict chronology of the 3 journal entries we need to execute. Step 1 is recording the gain at the reporting date. Step 2 is the big reclassification when the hedged payment is actually made. And Step 3 is a contingency. It's the reclassification that has to happen if the underlying transaction is no longer probable. Let's start with Step 1.
Okay, so we're at the reporting date and our interest rate swap has gained some value.
Let's say we're looking at an $8,000 effective fair value gain alongside a tiny $500 ineffective portion. As we established earlier, the effective portion gets to rest safely in our OCI waiting room. So we debit our derivative asset for the total $8,500, but we only credit OCI for exactly $8,000. What about that $500 ineffective piece? It doesn't qualify for the shield. It bypasses OCI entirely and goes straight to earnings right now as a gain. This perfectly highlights how OCI isolates just the effective hedging relationship, leaving the messy noise of ineffectiveness down in current net income.
Now we reach step 2, the hedged event. The company actually has to make its variable interest payment. Let's say that variable interest rate spiked, making the payment way more expensive than anyone wanted. But hey, remember our shield? Because we had our hedge properly in place, we get to pull funds out of OCI to offset that pain. Here, we reclassify $5,000 to earnings. We literally debit OCI, pulling it out of the waiting room, and we credit interest expense. This tangibly demonstrates how much our interest expense is instantly reduced by the hedge gain. The net effect is just beautiful. The company is fully protected, and their actual interest expense perfectly reflects the fixed rate they smartly locked in on day one.
But what happens if things go completely sideways? That brings us to step 3. What if the hedged forecasted transaction is suddenly no longer probable? Say the company just decides to pay off the debt entirely, meaning there won't be any future variable interest payments at all. The rule here is brutally strict. If the underlying transaction fails, the shield completely drops. The entire OCI balance crashes immediately into earnings. Why? Because the absolute only justification for holding that gain in the OCI waiting room was the high probability of that future cash flow. If the cash flow isn't happening, the matching principle says we have to recognize the derivative's value in earnings right this second. It's a massive consequence, which means accountants literally have to constantly monitor the probability of their forecasted events.
And that severe consequence leads us perfectly into our 5th and final section, the critical reclassification rule.
So here's the crucial point. When it's finally time to move amounts out of OCI and into the income statement, where exactly do they go? The absolute golden rule is that reclassification from OCI must hit the exact same income statement line as the hedged item. Correct reclassification perfectly matches the hedge directly to the item it's actually protecting. But here is the major pitfall. If you reclassify the hedge into some generic bucket like other income, you create a massive distortion that completely warps gross profit and operating income. Think about a hedge meant to protect the cost of raw materials. If that hedge gain goes to other income instead of cost of goods sold, a financial analyst looking at your gross margin is going to get a totally warped view of your core operational profitability.
Let's look at the correct line versus the incorrect line for those scenarios we talked about earlier. For an interest rate swap on floating rate debt, the correct line is interest expense. The incorrect line, other income or expense. If you've got an FX forward hedging a forecasted sale, that absolutely must go to revenue, not some random FX gain or loss line hiding below operating income. And for commodity futures on a raw material purchase, the correct destination is cost of goods sold, not other income. By matching these lines up perfectly, the income statement actually tells the true economic story, that management successfully mitigated a specific operational risk. Getting this wrong is honestly one of the most common and highly visible errors you'll see in financial reporting.
And that, I think, brilliantly illustrates the stakes involved with cash flow hedges. They are incredibly powerful shields for business, but they require meticulous documentation on day one, careful tracking through the OCI waiting room, and dead-accurate execution on the income statement. I'm going to leave you with this somewhat provocative thought. If your forecasted transaction suddenly failed today, are you actually ready for the immediate earnings hit from your OCI balance? It's a question every single financial controller needs to have an answer for. Understanding that risk perfectly sets us up for our next explainer, where we're going to dive deep into Category 2, foreign currency translation adjustments. Until then, keep analyzing, keep learning, and I'll see you next time.